first day of the May delivery contract is this Thursday in 2 days. 135 million ounces of open interest with only 77 million ounces of silver available for sale. They've already imported 1,626 tons, the highest level on record. In 2025, China was a net exporter of silver. In 2026, they are now a net importer of silver. Silver is just massively underpriced in the respect that the pull down in the price of silver, according to the Bank of International Settlements, was certainly wasn't fundamental whatsoever. It was more structural. BIS said it was totally structural, where you had the rebalancing of the levered ETFs, one of the big ones, but it's not UBS. It's not a name you hear very often, but they came out and said, we sold into the structural decline and bought back once we realized it was not fundamental. You're beginning to see, I think, the realization that this was an orchestrated collapse. And when you look at it that way and then see during that collapse that China imported more 2 months in a row, really 3 months in a row. Interest payments on the U.S. debt set to surpass $1 trillion in 2026. As of yesterday, I haven't seen the numbers from yesterday, but as of Friday, we saw a lot of open interest in silver, 135 million ounces of open interest. Those are contracts that are still out there that could stand for delivery. The first day of the May delivery contract is this Thursday in 2 days. 135 million ounces of open interest with only 77 million ounces of silver available for sale. That's a problem. What could possibly go wrong? Now, typically what we see is the open interest decline precipitously into that first day of delivery notices, and I'm sure we'll see that again. But the point is we're getting closer and closer and closer to a moment where there's a real problem with delivery. At this point right now, we don't have to signal the alarm bells, but what I am saying is that the COMEX and the CME group, I think, are losing trust, and you can see that by the precipitous drawdown that we continue to see, the deliveries, and many of these deliveries being sent out of the COMEX. We talked about in February, 39 million ounces left COMEX, but only 26 million ounces were delivered that month. So 160% of what deliveries could explain alone left the building. Now, again, there is still a couple days left, but here again, this is something we've been seeing every single month where the open interest dwarfs the amount of silver that could be delivered behind it. And it's getting late in the cycle where there's only 3 days left before these delivery notices come out. Something to keep an eye on for sure.
The silver market looks stable right until paper holders suddenly want metal instead of cash. With 135 million ounces in open interest against only 77 million ounces reportedly available, as Andy Schectman points out here, the real issue is not price but confidence in the exchange itself. When 39 million ounces leave COMEX while only 26 million are officially delivered, the numbers stop matching the narrative investors are being fed. For physical holders, that kind of disconnect can become a trust crisis long before it becomes a pricing event. Next, Andy Schectman reveals why shrinking inventories may matter more than silver's daily chart.
I wanted to talk about something that I saw regarding stablecoins and blockchain and the Genius Act. Before I get there, we'll finish with a little bit of talking about gold and silver. I think I probably spoke about this with you last time we were together, but just in case, we saw the price of silver get hammered in February and in March, yet we saw unprecedented January and February and March, unprecedented demand for silver imports into China, 78% over a month-to-month pattern. So in other words, surging almost 80% month over month to a record 836 tons in March, which was 173% above the 10-year seasonal average. That was the all-time high in March. February was the all-time high before the March numbers beat the February numbers. So as the price of silver got clobbered, February and March back-to-back were the two biggest imports numbers into China of silver in the history of import records. So here again, they've already imported 1,626 tons, the highest level on record. So in 2025, China was a net exporter of silver. In 2026, they are now a net importer of silver. In November of 2025, they came out and said, we are the second largest producer of silver in the world. We will not be sending any of our domestic stockpile out into the global market. And then in January, kind of pushing back against the classification of silver as a critical mineral, they came out and said, we will start to curtail exporting.
Silver was being sold aggressively at the exact moment China's buying quietly exploded. March imports surged to 836 tons. And as Andy Schectman points out here, that happened while silver was being pushed lower in plain sight. When a country moves from net exporter to net importer during a price decline, the timing exposes a disconnect between paper pricing and physical demand. For investors protecting long-term purchasing power, those divergences often appear just before broader markets realize supply is tightening underneath the surface. Next, Andy Schectman exposes why China's buying spree directly contradicts the weakness retail investors were shown.
They're one of the largest refiners of doré bar in the world. And so here you see, coinciding with a slowdown in exports, not going to send out any of their domestic consumption. They imported more in January, February, March, back to back, higher than they ever have before. And I think when we look at the pullback that we saw recently, where silver is just massively underpriced in the respect that the pull down in the price of silver, according to the Bank of International Settlements, was completely, certainly wasn't fundamental whatsoever. It was more structural. BIS said it was totally structural, where you had the rebalancing of the levered ETFs that happens the first or second week in January every year. It's notorious to see all sorts of volatility in all kinds of commodities and indices, because these ETFs, as a mandate to their prospectus, must rebalance after weeks and weeks and weeks in December and January, November and December, of silver continuing to go higher every week unabated. These ETFs, these massively levered ETFs, got way out of whack according to the prospectus. So they had to be rebalanced, along with the margin increases of 300%. Was a synthetic orchestrated collapse by the CME group. The worst time to raise margins when you have rebalancing of the ETFs. And that's kind of what the letter said that the BIS put out. And that's why you're seeing, I think, banks like in Switzerland who came out and said, I forgot the name of the bank.
Markets called it a correction, but the mechanics suggest something far more deliberate. Margin hikes near 300% hit during ETF rebalancing. And as Andy Schectman points out here, that created forced selling that had little to do with actual silver demand. When price declines are driven by exchange structure instead of fundamentals, the official explanation starts falling apart under scrutiny. For investors in physical metals, those engineered declines can become the moments stronger hands quietly accumulate what weaker hands surrender. Next, Andy Schectman unravels why some institutions bought back the silver they helped push lower.
It's one of the big ones, but it's not UBS. It's not a name you hear very often, but they came out and said, we sold into the structural decline and bought back once we realized it was not fundamental. You're beginning to see, I think, the realization that this was an orchestrated collapse. And when you look at it that way and then see during that collapse that China imported more 2 months in a row, really 3 months in a row, than it ever before, and become a net importer, it's a big deal. It becomes an even bigger deal when you realize that the margin increases flushed out all of the speculative froth. It also flushed out a lot of speculation in the retail industry, which really isn't driving this market, but yet a lot of people freaked out and sold. And I think the bottom line here is that what you are seeing or witnessing in real time is a very strong base being built under those who are holding metal right now. The speculation is not there. It is the people holding it for the correct reasons, and will, I think, provide a very stable, solid base for the next leg up. I think that's a big deal, something to certainly consider. I wanted to talk about, by the way, they did just reduce the margins on silver by 21.4% from where it was, gold by 14%. So they realized that they flushed everyone out, so they're going to lower margins now, and they shouldn't have raised them in January right at the same time they were rebalancing. You were guaranteed to knock the metal down.
Exchanges rarely reverse policy this quickly, unless the intended damage has already been done. After forcing traders out, margin requirements were suddenly cut. And as Andy Schectman points out here, that sequence raises more questions than the sell-off itself. Institutions often reveal their real view through action, not statements. And lowering margins after retail panic suggests the weak hands were already removed. For long-term silver holders, that can mean the next move starts after public confidence has already been shaken out. Next, Andy Schectman reveals why margin policy may be exposing hidden institutional positioning.
Couple of other things before I get to the stablecoins. Interest payments on the U.S. debt, we all know it's set to surpass $1 trillion in 2026, $88 billion a month, equal to spending on defense and education combined. We've all talked about that. Something I didn't know, found interesting over the weekend. There is something called Ferguson's Law, and it says an excess of debt over defense is a violation of Ferguson's Law. Ferguson's Law states that any great power that spends more on debt servicing than on defense risks ceasing to be a great power. This is because the debt burden draws scarce resources towards itself, reducing the amount available for national security, leaving the power increasingly vulnerable to military challenges. That's the case. We know that. And military spending is discretional. You have to borrow it. But it's interesting. The article went on to say that the Committee for Responsible Federal Budget estimates that just a 1% rise in interest rates on the 10-year Treasury from an average of 4.3 to 5.3 would add about $3.5 trillion to the U.S. debt over the decade. We are at that point where these numbers are getting to be very, very, very big and very troublesome. And those people who say that the debt doesn't matter to the United States are missing a very big picture. And that's why you're seeing rates go higher, because countries are selling treasuries, which is very unusual because every war that we've ever seen that involved oil, which raises the CPI, which raises inflation, would say, just like we're seeing right now.
If rates stay elevated for another year, the debt itself becomes a direct threat to purchasing power. Interest costs are approaching $1 trillion annually, and as Andy Schectman points out here, even a 1% rise in yields could add another $3.5 trillion to federal debt over a decade. That means the system becomes more fragile precisely when officials keep insisting everything remains under control. For savers holding cash instead of hard assets, this is where silent currency erosion can do more damage than any market correction. Next, Andy Schectman exposes why rising debt may force a policy response investors are not prepared for.
In fact, we can't raise rates. We certainly can't do that because we can't lower rates rather because the inflation is heating up so much. If we lower rates, you're going to reignite and add fuel to the inflation fire. And therefore gold and silver can't go higher. It's just a stupid argument because in 2019 with $1,800 gold and zero federal funds, we watched it go up 450 basis points in a year, the highest, sharpest increase in history. And yet gold is triple from where it was back then, nearly. Again, a convenient argument that is stupid and makes no sense. A couple other things I wanted to talk about. The media made a big deal about the Central Bank of Turkey selling its gold last month. They are quiet right now in the respect that they are now rebuilding their gold reserves, and they've added a whole bunch to their stock. They added 30.7 tons over the previous week, bringing their total gains to 36.4 tons, and reversing this drawdown driven by earlier liquidity operations. So again, they'll tell you when it's convenient. They'll say rising interest rates is bad for gold and silver. Now that's Gibson's paradox. To a degree it is. But I would argue that the mistrust or distrust of the dollar, of the treasury, of our geopolitical aspirations, of our political environment, of all of the irresponsibility we've shown fiscally and monetarily, that people don't want our treasuries right now, and rightfully so. And therefore, as rates continue to move a little bit higher, it doesn't incentivize people to jump back onto the sinking USS dollar.
The media says higher rates should crush gold, yet central banks keep quietly buying more of it. Turkey added 30.7 tons in a single week, and as Andy Schectman points out here, that directly undermines the claim that rising yields automatically make metals unattractive. If higher rates were truly restoring confidence, foreign institutions would be adding treasuries instead of rebuilding bullion reserves. For investors protecting savings, that contradiction matters because it signals trust in paper is eroding faster than official policy admits. Next, Andy Schectman reveals why central bank buying is exposing the weakness behind the dollar's public strength.
So anyways, I found that to be very interesting.
What do we know about returning it back to physical assets, gold and silver, being able to own monetary metals without them being within that completely transparent domain that is completely open to the scrutiny and inspection by the authorities?
Well, I mean, once the payment rails are on that chain, it's going to be hard because everything will be recorded on that chain. Until then, you have the ability, I guess, to pay by check or wire, and it's not on a blockchain. But that's kind of what Catherine is talking about. The anonymity in the name of convenience is the loss of anonymity in the name of convenience is something that people should think about very, very long and hard. Not a lot we can do about it anymore because it's law. It's coming into effect. So, keep cash, spend cash, talk to people about the benefits of cash, have your metal in your own possession, if possible. If you have to store it, it's in an IRA, then so be it. But anything you can do to distance yourself from the matrix, I think is a great idea. Catherine talks about she just keeps enough money on hand for liquidity purposes, for, purchases of day-to-day needs and whatnot, but everything else she keeps outside of dollars, keeps them in the form of assets. And I think in this environment, the dollars is going to face some major inflationary headwinds, and holding your wealth in dollars is like holding a melting ice cube.
Convenience is becoming the sales pitch for a financial system that records everything you own. As Andy Schectman points out here, once payment rails fully move onto blockchain infrastructure, privacy around wealth preservation could disappear faster than most savers expect. Governments frame that shift as modernization, but it also creates a system where capital can be monitored, restricted, or redirected during stress. For people holding wealth in cash alone, that creates a silent risk that has nothing to do with market volatility. Next, Andy Schectman exposes why physical ownership may soon matter more than price itself.
I don't think it is in your best interest. I'm not telling you to put everything you have into gold and silver, but I do think assets feed you, and liabilities, which the dollar is a liability, they eat you. And I think now, coming up now more than ever, it will be important. The effects that we've seen on the war have not really wrung out yet, because there was so many ships that were out in the seas that were loaded up before this happened that have now unloaded their fuel reserves into these holding containers across the globe, wherever they were being delivered to. So that kind of bridged the gap, but you're beginning to see those numbers start to trend down, and availability in places like Australia, they only have a few days left or a few weeks left of diesel reserves, I was told. And so, you're getting into a point where not only can it affect greatly the cost of goods, but also the profit margins of corporations, which leads to layoffs. You got guys like James Rickards saying, look, you got 20% of the fertilizer components coming out of the Straits, and you have only one growing season, which is now. When you're not properly fertilizing it, your growing season can become a disaster. He's talking about the possibility of worldwide famine as a result of all of this. It's not just the oil and gas, it's the byproduct, not only of food, and you can see that by watching the food indices. And I think I had a breakfast meeting with a very smart trader today.
Markets still look calm, but supply chains often break weeks after the headline disappears. As Andy Schectman points out here, shipping delays and tightening diesel reserves are arriving just as food inputs are becoming harder to replace. That timing matters because inflation usually accelerates after the public assumes the disruption has already passed. For investors holding only conventional assets, delayed shortages can hit portfolios, through weaker margins, higher consumer prices, and another wave of policy uncertainty. Next, Andy Schectman reveals why the inflation investors fear may not have fully entered the system yet.
He said to me, the name is the Invesco DB Agricultural Fund, symbol DBA. It's a blunt tool to track agricultural prices, and he sees it's breaking out. And he says, look, if I were still trading on COMEX, I'd be long on the grains and all of the food items, because it is breaking out right now, and that the fertilizer issue and the fuel issue is something that hasn't really played out yet because of all of the ships that were en route to drop off their supplies, but that's over now. Even if James Rickards was saying it stopped today, it takes days to get these things or weeks to get these refineries due to the pressure requirements and the amount of complexity that goes into this. These refineries take some good amount of time to get back up and running, that we have not even begun to feel the ramifications of it. Scary for sure. But these are all reasons why, prep, like you've talked about, reluctantly preparing for the unknown, for things that just come out of nowhere, and just seems that there's a lot of potential come out of nowhere type of issues surrounding us these days. But I think inflation will go much higher, and the byproduct of that is certainly a much less hawkish, far more dovish Fed. We want them to be dovish. It will be far more hawkish, rather, I should say. They want to be dovish. They want rates to go lower. It's not going to happen. They can't let that happen, where inflation is just going to get massively out of control.
Agriculture is starting to move before most investors even realize inflation is changing form. The DBA fund is beginning to break higher. And as Andy Schectman points out here, commodities tied to food often move before policymakers publicly acknowledge the pressure building underneath. Institutions rarely wait for confirmation because by then the pricing shift is already underway. For precious metals investors, rising food inflation can become another signal that central banks are losing control of what they claim is temporary. Next, Andy Schectman exposes which hard asset institutions tend to rotate into after food prices begin climbing.
So it will be more of a hawkish Fed. At least it will be either a hawkish or a do-nothing Fed. But I think the market will have its pound of flesh on this and will push the longer-term interest rates on the 10-year much higher. I would expect much higher inflation, much higher interest rates leading into the end of the year, and that will not be bad for gold the way that conventional wisdom is telling you, because the underlying asset of U.S. Treasuries, I don't think is trusted anywhere near the way it once was. So people will forego that little bit of extra premium or interest that they could get in holding a Treasury, and the lack of convenience, like France bringing back their gold, like all the countries we've talked about before that, bringing back their gold from the New York Fed and the Bank of England to have no counterparty risk at the expense of great convenience, the LBMA and the COMEX. These things are happening, and I don't think it's anywhere near resolved yet, to be honest with you.
Treasury yields can rise while confidence in the system falls at the exact same time, as Andy Schectman points out here. Foreign governments are accepting less convenience just to remove counterparty risk by bringing their gold home. That is the opposite of what should happen if trust in Western financial plumbing were actually improving. When sovereign buyers choose control over yield, private investors should pay attention, because institutional behavior usually shifts before public narratives do.